In today's video, I'm going to reveal the retirement tax avoidance strategies that work so well, they honestly feel like you're cheating the system. Most retirees unwillingly and unknowingly overpay thousands of dollars every single year in taxes. While the majority of people hand over 20 or even 30% of their retirement income to taxes unnecessarily every year, smart retirees using these strategies that I'm going to talk about today often pay well under that amount. The difference is so dramatic that it honestly feels unfair. And that's exactly why I'm making this video. To expose the hidden taxes that catch most people off guard, to explain why conventional tax advice fails catastrophically in retirement, and to break down the legal strategies that eliminate retirement taxes so effectively, you'll wonder if you're breaking the rules. Let's get right into it. These are the taxes that hit retirees the hardest and create financial burdens that most people never see coming in retirement. Let me break them down for you right now. The first thing, required minimum distributions from traditional IRAs and 401ks. These RMDs force you to take out taxable income starting at age 73, regardless of whether you need the money or not. The next thing, Social Security. Once your combined income crosses certain thresholds, up to 85% of your Social Security benefit can be taxable to you. The third thing, Medicare. Higher income means higher premiums for your Medicare Part B. We're talking about thousands of dollars, potentially more per year in Medicare premiums due to IRMAA penalties. And don't forget about your state taxes. Some states tax your pensions and retirement income heavily. This catches many retirees off guard, especially if you plan on relocating without proper planning. But why does all of this matter? Because RMDs eliminate control over your income. Social Security gets double taxed. You already paid taxes on it once while you were working. Potentially, if your income's high enough, you can pay taxes on it again in retirement. Medicare premiums compound over time, and state taxes can eat up 5% or more of your income. It just depends on where you live. These ambushes hit extremely hard in retirement. But the real tragedy is that conventional advice often makes things even worse. Traditional tax advice tells you to defer, and then deal with it in retirement. But here's what really happens. That tax-deferred money balloons. When you finally retire, your withdrawals that you're taking out push you into higher income tax brackets than when you were working. Most retirement plans fail to coordinate your income sources properly, meaning taxes and Medicare premiums go up together. And many completely ignore how state taxes and healthcare costs factor into that equation. Here's the bottom line for you. Conventional advice treats taxes like something you just have to live with. But strategic planning, like what we do in our Red Zone retirement planning process, sees them as something you can control and you should control strategically each and every year. So what's the antidote to this huge failure that's going on? Is it Roth conversions? That could be one way to solve the problem. Roth conversions turns taxable time bombs into tax-free wealth for you. You can convert IRA money to a Roth during your low income tax years, and the growth becomes permanently tax-free. You never have to take out RMDs again, and you can withdraw as much as you want each and every year tax-free, and it gets even better. You avoid these future bracket hikes that could potentially destroy your retirement due to higher taxes. You eliminate surprise Medicare premium spikes as well by avoiding the IRMAA penalty with tax-free income from your Roth. And you also can potentially leave behind tax-free legacy wealth to those that you love and you care about, because Roth assets are inherited income tax-free by your beneficiaries. Now that you understand Roth conversion's power and how you maybe should think about using it inside of your plan, I want you to fill out the quiz in the description below. I'll send you a free video walking you through your unique numbers and show you how you could use this strategy inside of your plan. But I want to go one level deeper with you now. What if you could eliminate the state taxes that you pay too? You can do this in a very simple way. Simply move to a tax-free state, and you could save up to 5% or more of your income every single year. Florida, Texas, Nevada, these states don't tax retirement income at all. And don't forget to time your move strategically. Doing that can save you thousands of dollars if you're doing Roth conversions or taking out big withdrawals for something you want to do big in your first several years of retirement. Add in a lower cost of living and possibly a better climate. This lifestyle and tax planning can all be done in one major move to enhance your retirement and save you on taxes. You can reduce state taxes by doing that. But what if you could also redirect your tax bill towards causes that you believe in and reduce your taxes while doing so? Let's now talk about QCDs and brokerage accounts. These are two incredibly underused tools that people forget about in retirement. The first one is qualified charitable distributions, and the next one that I'm going to talk about is how you need to tax optimize your brokerage account. So let's start with the QCD. Once you turn 70 and a half, you can directly donate from your pre-tax IRA to a qualified charity like your church, and that donation does not count as taxable income. This is a huge benefit that you need to be taking advantage of. Even better, QCDs, qualified charitable distributions, they count towards your RMD once you turn 73, but they don't increase your income tax on paper. So this reduces your taxable income, and it can help lower your Medicare premiums. And of course, don't forget, it could reduce that Social Security taxation that you're liable for as well. So now let's talk about brokerage accounts. Brokerage accounts are non-retirement investment accounts. And when and if they're used properly, they're incredibly tax-efficient tools for you. You can harvest capital losses each year to offset gains or income. This can be done through a strategy that we call tax loss harvesting. In addition to that, qualified dividends from your brokerage accounts are taxed at a lower rate than your ordinary income, say from your IRA account. These qualified dividends could potentially be income tax-free to you if your income is low enough. When you coordinate your withdrawals with Social Security, Roth income, IRA income, and qualified dividends from your brokerage account, you can game the tax system each and every year, getting more income with less tax due, which is what we all want in retirement. And here's the kicker. Many retirees now benefit from the increased standard deduction thanks to the One Big Beautiful Bill. As you can see in this chart, married couples over the age of 65 get an even higher standard deduction. It's currently $45,100 for tax years 2025 through 2028. This is a huge amount of income that you can receive tax-free before itemization happens, and that comes into play. Combine this with the strategies that I just talked to you about, and the result can be dramatic at reducing your overall effective tax rate. Together, these strategies give you even more flexibility, generosity, and control over your finances. Now, let's unlock the most tax-advantaged account available to you in the United States. Let's talk about HSA accounts. Health savings accounts, or HSAs, are triple tax-free. Contributions that go in reduce your taxable income. The growth is tax-free, and if you withdraw for medical expenses or reimburse yourself for past medical expenses, you guessed it, it's tax-free. In addition to that, after the age of 65, even non-medical withdrawals only get regular income tax on them, just like a traditional IRA. Also, with HSA accounts, you need to know that you can reimburse yourself for any past medical expenses that you incurred during your lifetime. So make sure that you keep those receipts that you paid out-of-pocket medical expenses for, because they can come in extremely handy for you in retirement to get tax-free income out from your HSA. Given that healthcare is one of the largest expenses for people in retirement, this is one of the smartest ways to build tax-free wealth for you to use for your future retirement. If you haven't done so already, I'd encourage you to take the quiz linked below, and be sure to check out the Red Zone Retirement Plan book. It breaks down this strategy in detail with examples for you. The book's available on Amazon, or if you simply drop me an email, I'd be happy to send one out to you. Now I want to tie all of these things together in one easy-to-understand, powerful framework for you to lower your effective tax rate in retirement. This is how it comes together. With our clients in the Red Zone retirement planning process, we love to do Roth conversions in low-income tax years to eliminate future tax bills for you. We also love to help our clients strategically relocate to avoid those state taxes that no one likes to pay. In addition to that, a lot of clients that we work with are charitably inclined. So we use those qualified charitable distributions once they're 70 and a half to support causes that they care about while reducing those future RMDs and income exposure that they have. And don't forget, brokerage accounts should be used with tax loss harvesting strategies inside of them. Qualified dividends from them are taxed at a lower income tax rate than your ordinary income. And don't forget to strategically time when and how you're taking income from all of these accounts. You need to also use HSA account funds to fund future healthcare needs without paying tax. Plus, take advantage of the expanded standard deduction here that you're going to get for 3 more years to even shield more of your income. All of these things are 100% legal. And when they're done properly, this can get you in a lower tax rate in your retirement, which gives you more money and more freedom to do things that you want to do in retirement while not paying the IRS. Professional guidance from a CFP like myself ensures that you don't miss key timing or IRS rules because things always change. But once your plan is dialed in, You're leveraging every advantage that the tax code allows you to have, and you should do this with your planning each and every year. So now that you know how to avoid retirement taxes so well it feels like you're cheating, the next step is to personalize this into your situation. You see, everyone's plan is different. You're going to have different wants and needs than someone else. You're going to have different pre-tax and post-tax amounts. So it's very important that you create a plan that's designed for your individual needs. I'm going to encourage you one last time to take the quiz in the description. Once you do so, I'll send you a personalized video breaking down your numbers and showing you how you can use some of these strategies that I talked about today to create a retirement plan that has less taxes due and gives you more money to spend on a daily basis. I look forward to seeing you on the next video.